say priceless. And I would say, no, there was a cost to doing that. That's the cost of coaching. The real cost is him putting in the time. All right. So here we are with the RL30Z slope sectors, Z scores for the sectors. That's what I was trying to say. And we're noticing that finance, that everything has turned the corner, and we got this COTA 2 pattern that we talked about the last couple weeks beginning to manifest broadly as the market itself went into sideways quiet. Tech is still lagging, finance is leading the way, and XLE is on the way. So Griff is part of your little reading the market and sector. XLF is leading the way. And we know that JP Morgan has been better than Goldman, but Goldman is starting to catch up. And so you might actually look at FAS and FAZ for as long as finance is in the lead, because that gives you a triple leveraged XLF. FAS long, FAZ short, finance is in play. Energy is beginning to work. Metals and mining are still doing pretty well. But the market itself and tech, so we saw from yesterday's report that tech is working. Semis are starting to make the move. And in the world of semis, NVIDIA was much better than Intel, which was much better than Texas Instruments. So there's some differentiation going on among the semis. And then there's differentiation among the broad Qs and the semiconductor itself. These three are reliable movers. And that's why I've added those to my herd. Okay? So everything looks in position for a surprising move. Because the other thing that we know is that the 200-day moving average has been rolling down, but price, which was at one point 20% below that, has now ground up to the point where it's 0.5% above the 200-day moving average. So it has just begun to cross. Right? Now, the 50-day moving average is below the 200 and starting to flatten out. And when it crosses, then they're going to call that the iron triangle or the iron cross or something, which is really the signal for the upside. So this is early days. And when the 50 crosses the 200, that'll be double plus good. But you can already see it happening in this bottoming action. Notice how exaggerated energy is in its swings. It's so narrowly focused and geared to the price of oil that you get remarkable swings. That's why energy itself is worth a program of routine swing trading on its own merits, independent of the market, although it often drives the market. It's also tradable on its own, which is why I watch that USO XOP as the oil exploration, and then XOM for a company, and then Devon Energy, and then also clean energy. So I look at those in that whole energy complex. All of them are derivative of what's going on with the price of oil. I would also add that I look at uranium as sort of the alternate because. So when I look at the energy complex, that's what I'm looking at. Inside the offense versus defense, we just saw the crossover so that XLY, consumer discretionary, is now in charge of XLP. This is another piece of evidence that the market shift has occurred. That this is when XLY is better than XLP, that's in theory a growth moment. Because the discretionary companies are beginning to outperform. So it's more of a measure of optimism in psychology. So this is a market that is finally wanting to make some gains. Everybody's looking at how bad 2022 was, and it wouldn't hurt their feelings for 2023 to be better, so they're trying to find the growth opportunities, and that's why you're starting to see XLY take over for XLP. Here's one from Charles on Merck. So Merck has been just crushing it, but the last 10 days and 5 days have been a sell-off to a baseline, and then had a couple days of recovery. So that gives us this almost Kata 2 style pattern. And if we see this as the solid support, and it didn't fail further here, it's already broken above the PSAR, and then Friday was a great big move up. As soon as that breaks above, he's looking to go long, and that's good with 1 unit of risk. And then you can see 1, 2, 3, 4, just to go test the peak. So before we talked about going from peak to peak, he's even going from the edge of the PSAR to the top, and he's not going to wait to see this break. He's looking at a tighter stop, and he can still get 4 to 1. That's a great intra-channel trade, and if it breaks above this, look out above, because above 116, there is no resistance. That's an all-time high, and then everybody that owns Merck from back in here will be committed to just what you couldn't convince people to sell. There was just that much selling pressure. All those people tolerated that and then continued to support it and started buying it on Friday on a long weekend. So Merck's in great shape. That's an example of connecting longer time frames, sectors, and markets to the individual target. Okay. All right, here's one from Dan. Now, he's doing Intel, and the reason to be interested in Intel was because it had already, on the daily, had made this move. It had come right up into the test of the previous peak, which was the peak on both the daily and the winter. I like the fact that it's got a Kata 2 on the weekly. This one tested. He got the entry, and then his risk box here. Now notice that that's inside the noise. So he took the 1 hour loss on that one. A more logical risk box would have been this one. Because until the PSAR breaks, you don't have any evidence that this thing is failing. And so he actually exits in the noise. I could live with a risk box that came to the bottom of the dragon, which is about 0.8 of the, it's 80% of the way down. But in either case, he gets a chance to make that a winning trade instead of a -1R, but it's on half the position size. Because if your MMRB is here, and that lets you get 200 shares, if you double the size of the risk box, you can now only afford 100 shares because you're taking twice as much adverse heat in order to have a constant number of dollars at work. So for instance, if my risk box here was 50 cents and I wanted to risk $100, then I could have 200 shares. But if I put that same $100 at risk and my risk box is $1, I can only afford 100. Same dollars at risk, different size MMRB drives difference of position sizing. Okay? So I still like this one, by the way, since we're already committed to understanding this thing. I mean, I still look at this as higher lows, and so I could take the PSAR box. I would still be willing to take that trade long, and then now I can actually use the PSAR dot as a genuine risk box, and I would just set up the same trade because I think that's going to work from what we've said before when we looked at the semis and the indexes and the market conditions. So I would just keep firing and take that on as information. This is Moderna. And this is that same issue that he had set up this trade box. And again, notice that the box, that you don't get evidence of technical failure until, I could argue, at least the Bollinger Band mean, or the leaving the river, or leaving the dragon, or the PSAR flip. In general, I would say it's better to use the PSAR flip on the hourlies and just accept that that's how much adverse price action you got to see. Now recognize that if he does that, he's still in the trade up as far as here, and then if he takes it where it leaves the dragon or hits the PSAR, he can actually make that trade as a win, and that would be about a 0.5R win instead of a 1R loss instantly. Now, what I want to commend him on is the re-entry that even after this reversal, which got him out at -1, that he was able to re-enter here and still keep a piece. Now, if he'd been able to, so notice how noisy this is. That's why I think even on the hourly, you got to take a look at that as the manageable risk for the 1R loss. You will certainly never take more than a 1R loss that way, but it gives you a chance when it's choppy. Okay, and you can see that when you take this over to the daily, how tightly you're well inside the. Even if you use this wide move, you're well inside the noise, because this bottom here is this. So rather than getting noised out and being, getting chased around, just take the wider stop and accept whatever size position that is. It's the technical size of the box that matters. And this thing can certainly go up to 210, so you got plenty of upside room on this. It could easily go to 220 before this is all said and done. Okay. But I commend you on the re-entry. Do we get Microsoft? Yeah, so Microsoft, this is another case where, so this one worked out to have the tighter stop. But again, with his wrist box here, see, I would rather see you at the bottom of the dragon or at the PSAR flip and just accept twice that as the stop. Because look what happens if you just use the hourly PSAR. Instead of getting noised out, you get this trade on that much risk, and you might have taken that as a second entry on a Z3 pinch breakout. But even if you just took one, you get, instead of a 0.33, you get a 1.0 swing trade on the hourly frame. Now, you're trading this on an hourly. There's nothing to say that we couldn't also have gotten in here on the 3-minute. My sense is you don't want to do that. But if you're just using the hourlies or even the 30 minutes, I think that wider stop is going to keep you from getting pulled into tactical trading. Because what will happen there is you'll end up watching that thing constantly, but the bar will never move because it's an hour long. And then you're trying to watch the price inside the hourly bar, and that's the hardest way to day trade, is using a really long-term bar and then just watch the price needle moving up and down inside that thermometer. So if you're going to use hourlies, use the wider stops that are driven by, the PSAR flip. And then maybe something like the PSAR trail, you'd be in great shape. But this still looks really good, by the way. It just PSAR flipped Friday. So this thing still has ways that could get up to, 252, which is up in here. So on this one, as soon as that breaks above, I'm long again, instantly. So what kind of a stop would I use on that one with the hourly? I would say, well, here's the belly of your RL10. So if you got long at 240, a $4 risk box. That's the price that tells you that this could be failing back to here. Not until it gets below there, so you have to accept a $4 risk box. Intraday, the R10 on Microsoft is about $1. So if I'm using a 3-minute chart in Microsoft, I could use $1 of risk. If I'm using the 65-minute chart, because of the size of the pattern, I got to use $4. So meaning if I was going to risk $100 on the 3 minutes, I could have 100 shares as my standard load. On 65 minutes, I'd be trading 25 shares because 4 goes into 125 times. So the choices that you make on time frames is driving the size of the position sizing, because you need to respect the technical signals on the time frame that you're making decisions on, right? Let me know tomorrow if that's not clear. Okay, so that's the frames that were posted. I'm gonna go through a series now of oops, let me cancel that. Yeah, I'm going to take a look at my tactical herd, if you will, and I'm going to go into TC2000, and I'm going to sort it on the column that says reward to risk. So this ratio, reward to risk ratio, on this particular view, this reward to risk ratio is for swing trading. And so it looks at the 10-day high. So every symbol has a 10-day high. On VXX, it happens to be, it's the blue box is the 10-day look back. So I'm looking at a 30-minute chart here. So this yellow box is the size of the 1-day range. So that was Friday. This light blue box gives me the 5-day range. This darker blue box gives me the 10-day range. And then this black box gives me the 30. So the 30-day high is here. The 10-day high is here. So when I'm computing swing trades, I'm just looking back 10 days to the 10-day high and saying, I wouldn't be surprised if this thing had sold off that much. That may be an exaggeration, that if all it did was fight its way back in the next 10 days back to the 10-day high, I'm not allowed to be surprised by that, because the same energy that took it down this far, that the bears are winning, maybe the bulls could take on with their hunger. See if the bears take it that far, now they're satisfied, and now the bears or the bulls come in hungry, that same level of hunger, they may be able to take it right back up to the 10-day high. So I wouldn't be surprised if that critical state leads to just a retest of the 10-day high. That's my psychological hypothesis here, right? So what I'm going to do is simply take the 10-day high as my reward. And then I'm going to say, what if I just used, for standard practice, yesterday's or Friday's range box and just call it the yellow zone? That's why I have that listed or shaded as the yellow zone. Check or hold. And if I just said, what if I used a breakout from yesterday's price as the green zone? That would be the region where I want to be long. And if it broke below, that would be the region, that would be the red zone where I want to be short. So I'm just using a simplified green, yellow, and red, and I just call that the mechanical frame. So if I use the yellow box as the risk, I can now use that as a standard unit of risk and say, how many of those in this to the top? When you do the math, it's 4.4 in VXX. And all I really do is show the reward to risk to the upside, because the fear is harder. If this thing collapses, I know that whatever that was, there could be another one of those on the downside. Whatever reasons made this thing fail are still in play. If it keeps failing, then all those reasons are still in force pushing it down. So I don't even have to know why. I just need to know that they've been winning. They could keep winning. There's momentum to the downside, and I trust the momentum of fear. That you think you're afraid now, you haven't even seen fear, typically. It comes in waves and stages. Whereas courage, which is what allows you as a little field mouse to venture out to get the cheese, is a very fragile thing. And that's why it's normal out of a compound critical state like this to see very tentatively working way up. But if it fails big. And so it's not symmetrical. That's why the collapsing dragon is what we love. And if you just looked at this chart, collapsing dragon, fail. Notice what happens when this little tentatively comes in and then fails through the collapsing dragon. Collapse. Oh, it didn't fail until it got to here, and then collapse. And when that collapsed, fail. And when that failed, fail. Ladies and gentlemen, the collapsing dragon. You don't even have to know anything else except that. Here's another one. Collapse. Here's another one. Collapse. You can do that 1,000 times. Now, on the other hand, notice the behavior of price to the upside. If this doesn't fail here, it grinds, collapse, grinds, collapse, grinds, collapse, grinds, collapse, grinds, collapse. Failure to follow through is information. When that rolls over and the PSAR... Now, notice what happens. Notice where the pocket is. There's your collapsing dragon. Here's where it rolled over in the peak of the RL10. Here's where it crossed the PSAR. This little space inside here is front. That's a pocket entry that is front running the collapsing dragon. Now, the size of this little pocket was almost insignificant. But over here, from the edge of the dragon down to the collapsing dragon. This is where the pocket is. It's still monkeying around. So if you got short here, it hasn't started the big collapse yet until it actually breaks below the official collapsing dragon, and then that collapses. So this is a little bit front running the collapsing dragon. That is the official confirmation. In my view, you are more justified in taking pocket entries short than pocket entries long, because the collapse happens faster and bigger. Notice what happened here. This little pocket, it couldn't even get to the PSAR and then failed immediately. So that's an example of like a front running an SSC and then it fails. You got to get out of that immediately so you can get that. So these are very speculative front running, but you do not have any trust or belief or confidence in that particular one. You know that once in a while they will go, like this one went. But when they don't work, that failure to follow through, that's telling you what's going to happen. So think back to that previous discussion for Griff. So back to here. So what I'm doing is I take my tactical set. This is about 50 symbols. And 95% of my trades come from that just subset of 50. So it's a mix of broad indexes, sector indexes, individual targets that are connected in a logic chain. You know, the SPY versus the globals versus emerging markets in the globals, which are a more violent form of globals. These are EFA is the large cap Euro Asia. There's a IEV, which is just the European 350, and then there's an Asia less Japan large caps. And then from the S&P, I can look at IWM, the small caps, or I can look at the Qs as the tech. And when I look at the Qs, I can look at XLK, S&P tech versus the Qs, and I can compare that also to the FANGs. Which is the uber large caps of, Meta, Google, Alphabet, that kind of stuff. So there's really three forms of tech, of broad tech. And then in tech, I can go to the semiconductors. And from semiconductors, I can go to the three that I care about, NVIDIA, Intel, and Texas Instruments. Now you could also, if you wanted, add AMD and Applied Materials and all that. You could get as specialized in that as you want. I just want to get three movers, so that if S&P is working and tech is better and semis are better, it may be that one of these three is even the best. And so I can quickly follow the logic chain to get out there. In the same way that I can look at XLB, materials, and I can split that into XME, metals and mining, or I can go over to the combination of cut and wood as two lumber ETFs. And then metals and mining, I can look at Cliff, Alcoa, and U.S. Steel. And if I look at finance, I can look at FAS, FAZ, JP Morgan, Goldman Sachs, Visa, Bank of America, So I can find ways to get that done. If I go to energy, you can, what I showed you before. So when you take a look at all of these things, that's the logical diagram that puts them all together. And I have other things in there like EWW, EWZ, lithium, Tesla, Rivian because I want to compare something to Tesla. Wheaton Precious Metals for gold. I have IYR for residential real estate, and Simon Property Group as a proxy for commercial real estate. I have XBI for biotech. I have the two ARC Innovation and ARC Genomics to get the fanboys for high-tech growth and Kathy Woods to play one way or the other. So, and then Treasuries is an alternate to all of that. So as I assemble my tactical symbol set, or in my boot camp as I call it, there's 50, and that's the one that when this is dynamic, I can see, and I sort it by percent change, I can see the best performers and the worst performers. And then I can, so if I do that, let me just do that. I can find the actual, when I'm managing it intraday, I can just find where's the cut line of things that are working versus not working. And then where's the S&P as my baseline. So if the S&P is going up, I want to be in these because they're all going up better than the market. Hey, there's XLB and there's Alcoa. You know how quickly I can go from market up to materials to Alcoa and find Alcoa and trade that? Faster than I just described it. Because I can sort it this way, find the S&P, and then read down. Where are the movers? There they are. Oh, Alcoa and NVIDIA, instantly go to them. Done in one. Hey, this is interesting. Alcoa was up here and U.S. Steel is down here. I don't mind trading U.S. Steel short because there's real reasons for people shorting U.S. Steel. I don't know what they are. Don't need to know. I just need to know that a bunch of people that own U.S. Steel are selling it in a day when the market is up and materials are up and Alcoa is up. What is going on? So that tells me there's something special in the sell-off of U.S. Steel, so I can participate in the momentum to the downside, and when it bottoms out, maybe I can get an SSC and then some COTA 2s as it recovers from the over-exaggerated selling. And that's all I do. Find the movers using my little stack of 50. So now what I'm doing is taking that same set of 50, and now I'm ranking them by reward to risk ratio for the swing trade and displaying it on a 30-minute chart. And what I'm looking at is the reward to risk ratio is defined as the 10-day high as the price for reward, the mechanical entry for risk consisting of, if I got long automatically here and 1R and then short here on a failure, then that would be my 1R. So that's my risk, my mechanical risk. This is my mechanical short. This is my mechanical long. Can I trade inside the yellow zone if I can see a 2-to-1 between the red and the green line? Meaning that I would have to have, whatever my risk box was, I have to have 4 of those inside here in order to justify that. That might be, it opens here, it doesn't sell off, but starts to move straight up. I can get long here. And then I have a hope of getting 3 intraday units of reward. And then if it goes through that, that's where I would pick up the swing trade. And look, I can fund that with the money that I made on those 3. So the combination of intraday yellow zone trading plus mechanical swing trading is what creates hybrid trading, which is what Griff is learning to work on. And I've got, if that's my unit of swing risk, I've got 4.4 of those back up to the reward, which I know because of the reward to risk ratio computation. Hey, I'm showing this on the basis of my 50 tactical symbols. Here's what's nice about TC2000. I can just go to the S&P 500, and now I'm collecting 50, and now that was the index. I could do that. I could do it on the S&P 500. BAX is 9.7 to 1. Now, I can look at that and instantly say, I love this as a mechanical swing trade. It's had 5 days after the sell-off. It's had 5 days, and it never failed further. That is information. In fact, it's had one little push up, and that failed. Second little push up, that failed. But it's still holding, so now it's in a range compression. How compressed is it? Well, if this was my standard unit of risk, there's 9.7 of those up to the 10-day high. What if it only got halfway up? Well, then that's a 5 to 1 trade. And guess what happens on this one? See this little peak RL10 right here? If I were to get long right here and it gets up to 1R, you can tell by inspection that's 1R. And that's been the lid. If this breaks out from here, there's no resistance in there at all until it gets up to here, because this was all of a gap. So if it breaks above this price, 46 and some change, it's going to close the gap. Now, how fast is it going to close the gap? Well, it moved that far in one day. It moved that far in one day. It might go like this. It might take 2 days. But if it gets to here, I've got a 4 or 5R trade in hand. So this is a low-risk idea. Why? Because if I set this up as a long here and a short here, what if it opens here and just immediately fails? Would you have any compunction about getting short there? You shouldn't. Because this is resuming the pain and suffering that caused all of this. Why? Because previously that support level held, but now it didn't hold. That means the bears are coming back hungry for more, and that's the beginning of a new trend. How big could that be? The size of the previous trend? I just clone that and say that's how far it could fall for reward to risk purposes. So when I have in the mechanical reward to risk an enormous payoff, I don't even have to worry about, is there a justification for that failure? I've already seen the justification. Plenty. This is the one that I'm interested in. How many of those to the upside, just to the 10-day high? So the reward to risk ratio is a mechanical entry, mechanical risk, standard work computation, just for approximate sizing of the opportunity with which I can rank all of these other ones. So if I really like that, we think of this as a max pain range compression, and that's the I'm going to present this to the Society for Technical Analysis in February, and they're going to love this because this is easy. Because I can do that on the S&P 500. I could go to the NASDAQ 100 and find Pep Boys, perfect. Hey, it was supposed to fail Friday, but it didn't. In fact, it held and made some upward moves. I don't even have to wait for mechanical entry. I could just get long there and then reinforce if it gets here and reinforce if it gets above there and just all the way back to the 10-day high, and it's 4.2 to 1. I could look at the... You tell me what you want to look at. The high cap 1,000. So this is the Russell 1000, the largest 1,000. There's LOGI, perfect. There's BAX, Booz Allen Hamilton. If I go to the other extreme, these are the ones that are the strongest because they're already at or near their 10-day high. So I can find the relative strength leaders. I just like the discipline of the max pain range compression, because I believe that the big sell-offs are more likely to be the result of an emotional reaction than guys that have climbed this hill carefully. It's that fear overreaction that is stabilized, which is what I like. So what I really want in max pain range compression is the largest possible sell-off from the 10-day high to the current price, combined with the smallest possible daily range. So this would be twice as good if the daily range had only been this, but it was this big. But still, that's 9 to 1, 10 to 1. But if it had been only this box, it would have been 20 to 1. So what I like about TC2000 is it gives me the standard markups, and it lets me very easily construct. Like if I went to the world of thousands of ETFs, you'll see some. There's JJS. What's it? Soft. So that's the consolidated index for all the soft commodity contracts. They're at a natural low. So if I'm a futures trader, I could do that. So this is the power of the TC2000 to rapidly find things. I could go look at Canada. I could find S&P 100s. So if I wanted just that, the top 100, right, that's the OEX. Abbey V Inc. Perfect. Ready to trade. Those are all very liquid. Hey, there's Johnson & Johnson. Nice. 4 to 1. And now I've got all these other computations. The R10 is 30 cents. The R3 is 60 cents. You know. The size of the intraday, the range stat divided by my risk is 1.6. So I can start figuring out how big the yellow box is relatively. It gives me some other stats over here for what the 10 bar. I can find the 10 bar high, reward to risks, R stat over here. So TC2000 is a powerful way to do all your sorting and scanning and coding and judging. And you can see I've got the 4 seasons of MACD posted in here, the color-coded RL10 to help me see where things are. So I say all that just to set up, going back to my personal lists. Like I like this XLP components. If you took the S&P sector XLP, which is all those consumer staples, I can break that out into just those components, and I can find the ones that have been doing the best or the worst. So GIS, General Mills, is horrible, and the one that's been doing the best is Brown-Forman and Clorox on a 10-day basis, right? So Clorox is actually the strongest in XLP. There's Walmart's in the middle. So you could specialize on this as much as you want. You can look at industry indexes. Every one of these is that's the technical name for broad indexes, tobacco, medical distribution. So you can be as specialized as you want. So I'm going to go look at personal boot camp. That's just my tactical set of 50. Just so I want to be clear on that. And I'm going to sort it by reward to risk ratio because I want to simply look at the ones that offer me this my favored default pattern, which is max pain range compression. The way you get the highest reward to risk ratio is the largest sell-off divided by the smallest risk box. So VIX, and I'm just going to quickly scan through these so I can note the ones that are interesting. I like agriculture DBA because it put in 2 days of recovery after significant sell-off. XLP, nice. Microsoft, that's actually pretty good right there. It has already had 2 legs on the long side and is ready to go. Brazil in great shape. You can see that I had on Friday closed the swing trade that I entered from here on the 5th on a COTA 2 with that much risk down to the dot, and then closed up here on Friday because I didn't want over the weekend risk. Plus it broke through the PSAR and cashed. Marijuana, I like it. Look at that range compression. Ready to buy it. Texas Instruments, lithium. So there's very few that are going to have favorable reward to risks because the entire broad market itself has been on a recovery up into sideways normal. So there's not a lot of things better than 2 to 1. In fact, there's only 3. XLP, agriculture, and VIX out of my favored 50. So I got to be more interested on the breakouts to the upside. So I might reverse that and look at the ones that are the biggest winners. Aussie dollar, and now I'm going to bring this out further so I can... Now, if I looked at these on a daily chart, I would also see the same kind of sensibility, right? If I go back to the VIX, notice that's what the VIX looks like at the bottom end of its, from its 10-day high sell-off and this little compression, but that's part of that volatility leaving the market. Agriculture, XLP. And that's the point I want to make about this market. XLP is the 3rd best reward to risk ratio to the 10-day high, and it's already looking pretty strong. Microsoft in good shape. Is there any wonder that I like EWZ? At this breakout to the upside, it's already in a COTA 2 and it's going to continue. Now I can start saying, instead of just targeting the 10, I can target the 30-day high or the peak of the RL10 or the peak of the dragon as upside targets. So now you have a adaptable framework in which to start framing these swing trades across the board. And I love marijuana right there as a trading vehicle, not as a device. Texas Instruments, lithium, Tesla, love it. That's failure to fail further so far. That's tentatively to the upside, and it just PSAR flipped. So if you're not ready to own Tesla to the upside, then you're not really a swing trader. You're something else. Now, my swing risk box should be... There's my little... should be down here. So although that is my mechanical one-day box, if I'm a swing trader, I should be here because of that dot. So I got to actually have two of those daily boxes. But that gives you enough wiggle room for this thing to finally make its move. And that's about $12. Okay. So that's how you guys have been hanging in there. We're at this for 2 hours. That gives you an idea of swing framing and some ideas on hybrid trading. That was a hybrid trading workshop in 2 hours. So there you go. Have a good weekend, and we'll see you tomorrow.